All right, the Fed just announced their interest rate hike of 0.75%, 75 bips, to take the rate to about 4%. The market skyrocketed at one point based off of that. It absolutely went straight up, and it's still up. The NASDAQ at one point was down 1.35%. Today it is now up almost 0.5%. So the reason why the market's reacting positively, the Fed has started to hint that they're going to slow down their rate increase, which, by the way, I'm not saying it's good or bad. I'm actually surprised that they even raised rates this fast. I was absolutely floored by that, especially with this low interest rate environment we had for so long and this public pressure of keeping rates low. But it took some other public pressure in order for the rates to jump up, and that was inflation. So the Fed starts to see a hold down in inflation. They're going to probably temper how much they increase rates. It's going to be a little more as they go along. Who knows what happens? It's all speculation. Don't trust anybody you hear who says this is going to happen. I'm reacting here. I see the Fed raise rates. Again, if you told me a year ago they're going to raise rates this much, I would have absolutely not believed you because of how dovish they've been the entire time before then. So it just goes to show how much the Fed really isn't an independent body. It's supposed to be an independent body making decisions, and their goal is inflation and unemployment, which this is important. But, to think that 2 or 3 years ago, if you watch our videos from 2 or 3 years ago, we talk about how is this not going to lead to inflation, writing these checks to everybody, making sure that people don't have to go to work and get a job because they're going to get $600 a week from the federal government. It just naturally said there's going to be inflation. Now, is that for sure? No. But again, if you're a betting person, which kind of am, I sit there and say, okay, what does this mean about the future? Now, the 10-year treasury historically is about 4.5%. And right now it's hovering around 4%. It goes up to 4.2, down to 3.9. So we're getting close to a historical norm on interest rates. Mortgages have absolutely skyrocketed. In January of 2021, the average, the low of the 30-year treasury, the 30-year mortgage was 2.65%. It is now 7% or so. So we have much higher rates. You've seen a massive slowdown in real estate sales and definitely refinances. I read some article the other day that before the rate increase, 19 million homes qualified for some sort of refinance in terms of could get some money out, could save some money on a mortgage. And now it's down to 300,000 homes. So you got to think the 300,000 homes that had not refinanced along this point but had high rates, they probably had high rates for a reason. Maybe there was a bad credit situation in the time that they got their last mortgage to now, years ago, they couldn't change it out. So these are things that have to go through. Again, your job should not be to guess what's going to happen next. Your job should be to look at what's going on out there and decide what that means about the future. I don't want you making alarming decisions and selling everything and buying everything just based on that. Just sit there calmly and say, okay, so what does it mean about the future? Because years ago, when rates were zero and people were buying investments like stocks like crazy and stocks were going up to nosebleed prices, your job should have been to say, okay, what does it mean about this world that everybody can be making a lot of money in stocks, that we can have year after year records on stocks, nosebleed valuations higher than the historical average? That's what I want you to do here. Even though rates are higher than probably a lot of you have even seen in your lifetime, because a lot of our viewers are less than 30 years old. So you probably don't remember a time. This is the highest rates have been since January of 2008. That's before Lehman and all those guys collapsed. We had the market crash, the financial crisis crash was in September of 2008. So this is well before then. That's 14 years. Look at it this way. 14 years before 2008 was 1994. And rates back then were 8-9% on a home mortgage. This is the incredible times we're in right now. So again, what does this mean about the future? Well, I think they're basically saying, the Fed's saying, hey, I personally believe they're probably succumbing to some sort of political and public pressure. Because back in the day when the Fed was created, there wasn't social media. There wasn't immediate reaction to everything. I mean, literally at 2:02 p.m., markets skyrocketed. They announced it too. I mean, that's the whole point here. It's like, okay, what is going on with this? So guys, I need you to subscribe to this channel because we do videos like this every single day. We do 2 or 3 videos. We have over 1,800 videos in our YouTube library. We make immediate reactions. I'm recording this video at 2:32 p.m. Take a look at your computer or your phone. What time is it right now? It probably was posted. It's probably going to post here in the next 15 or 20 minutes after this video is recorded. So we are very active. We want to do immediate reactions. So you must subscribe in order to get these. So back to the Fed. Guys, the bottom line is the stock market's overpriced. Whether the Fed drops rates or increases rates, the only thing the increasing of rates does is it gives people a justification to sell off stocks, which is interesting to me because now stocks are up, even though rates going higher should be a bad thing. The market just goes up and down randomly sometimes. And this is very unexplainable. And that's why I don't think about it. I got a text from one of our Everything Money community members who has my cell phone number. And he said, because he's done some work for me, and he said, Paul, this is crazy. I'm like, yeah, it is. But, it is what it is. I mean, we had low rates for a very, very long time. And now we're going to have higher rates for a very long time in all likelihood. How high do they get? I have no idea. When does it happen? I have no idea. But the world's balance sheet, not just the U.S., has skyrocketed in terms of the liabilities they have out there. Why? Because money was so cheap. When money's cheap, it floods the world with money because interest rates are basically the cost of money. The more expensive the more higher interest rates are, the more expensive it is to have money, to borrow money. So it's less likely to happen. And this controls inflation. It causes all these things to work together. These are the main fundamentals of the economy. Now, in terms of home prices, inflation's still helping home prices too. When you have a higher cost of labor and materials, it's going to cost more to replace the exact home you're in. So home prices might continue to go up. I don't know. All I know is that the sudden increase in interest rates, I was like, well, listen, if you own a mortgage business, which one of our good friends does, your refinance dollars are going to become harder and harder. Again, though, did I see rates going up from 2.5% almost to 7% in a year and a half? No. That was obscene. And I'm like, okay, but it happened. Am I upset about it? No. Am I happy about it? No. It is what it is. My job is just to react to that. People used to say to me when I do videos in the past, go look at our Google videos in the past. Google's now trading at what? And this is a prime example of what I mean by, how I think about things. Google's currently at $90. That's split adjusted. It was $1,800 at this point, okay? The highest it got was $3,000 or so. I remember when it was around the mid 2000s, we did a video and I said something like, at that time, I'd buy Google at like $1,300. Okay. Now I remember people writing, Paul, it'll never be there. You're crazy. It'll never get there. First off, they're wrong. But secondly, I said, okay, then it never gets there. But it'll eventually get to a point where the fundamentals will get better and the stock price might stay stagnant or go down a little bit. And at that point, it's then a buy. The same thing I would look at with interest rates. They're going to put interest rates where they are. I have a lot of real estate. I have hundreds and hundreds of apartment units. I never think about interest rates. People would say, that's stupid. You borrow money. Yeah, but my goal is to buy a good real estate deal. A good real estate deal will do well, whether my interest rate is 4%, 7%, or 3%. If I need a low interest rate in order to make money, I'm not a good real estate operator. That's absolute fact. If I'm a good stock investor, I don't need interest rates to be 0% to make money. If I'm a good investor where I understand what value is, I don't need the economic conditions out there to be perfect for me. Because in that case, I'm not very good. This is a random example, but it's the same when people tell me, oh, my kid is moving to X city because there's more opportunity there for them to be successful. So your kid needs a good city in order to be successful? That's not a successful kid. If you need 0% interest rates to make money in stocks or in some sort of investment, you're not a good investor. That's just it. But you're watching this channel, and I want you to hear this saying, wait, I'm a smart guy. You should be saying, I'm a smart lady or guy. I can learn how to make money. Now, does that mean my investments are up? Absolutely not. Just like Warren Buffett, his stocks are down this year. Berkshire Hathaway stock isn't, but his stocks within Berkshire Hathaway are. We're still going to have drops in our stock prices, but our goal is to make long-term decisions based on what's going on today. And we cannot affect individually what's being perceived in the market. All we can do is make decisions based on that. If you ask me right now, I'd say, yeah, raise interest rates 3% today. Like, go for it. I don't care. That would actually help me a lot more. But people out there would be crying and screaming and saying, Paul, you're terrible. That's why I can never be Fed chairman. Because I wouldn't care what people thought. But I actually probably would care, and that's why I don't want to be Fed chairman. Because I'd eventually fall to the peer pressure and the public pressure. And Jerome Powell Case in point, he said he was going to raise interest rates before Trump came into office. Trump came into office and bullied him right into keeping rates low. All right, it is what it is. Just take everything that you see as a way of understanding the world and say, what does this mean about the world? Not what's going to happen exactly, just what does it mean in general about the world? And right now, with rates being at 4%, I look at it saying, okay, that's where we have been in history, and we still have really high asset prices. I don't know where things are going to go. I still think we're in a long-term bear market. I think we have a lot lower to go on the stock market. It was overbought. It was oversold in September. Now it seems a little overbought because we had a record October, the best October in history for the Dow. Okay, these things just say something's not feeling right. I don't know, but I'm not here to guess. What I'm here to do is say, here are the investments I like. I'm going to make them, and if they go lower, I'm going to buy more of them. So again, subscribe to this channel. Keep watching our video. Later today, we're going to have more videos coming out on earnings reactions. So please subscribe. Thank you very much.